Hey guys, this is Sean again. This is a video to go through the ticket template that I've created. This one is more for your advisors that want to actually illustrate the impact of living annuity drawdowns. It's exactly the same template that I shared yesterday. The only difference is I've included the age of the person that we're tracking, the current age, and under the tax table, we've got an age of retirement. If you change this amount over here, currently it's on age 65. If we change it to 60, it'll then look at the year of 60, which is 26 years from now. So let's just work on a client here that's 35 years old, wants to retire at 65, currently has a taxable income of 1.2 million Rand, increases that every year on average at 5%. In reality, it could be low because of obviously the ability to increase salaries in today's markets. But let's just argument's sake, say this person is a engineer or self-employed, whatever it is, and they're able to do so. So this template does exactly the same as the template that I shared yesterday, as I've mentioned. I would recommend going through that template just to understand the cash flow. I don't want to do that again because it's exactly the same principle. What I did was I turned everything off in terms of escalations and growth. I made this annual, and then I showed the impact of making the rebate payment at the end of the financial year. So you wouldn't get an additional payment into your fund in the first year. That 82 then carries, sorry, the 98,400. It was 82 because I made it annual, as you see here. That are carried forward into the next year, and that got 10% return because that's the beginning of year two, that um that lump sum payment that you made. And you'll continue doing that as you go on year on year with your contributions. So in this case, we're looking at 94.7 million versus 89.69, which is a 5.58% difference, which means that you grew your fund 5.58% by reinvesting your rebates every single year and getting your 10% compound return. And in addition to that, you've got your contributions that do not contribute towards your deductions. So it's 14.168 million. 14.186 million is mentioned over here. This section here explains the tax year that you're in. The reason I'm just saying tax year, because every single year you will have a tax calculation, and SARS basically says use it or lose it. So if you don't submit a tax return, you cannot. So if you do submit a tax return, you don't submit the retirement annuities, etc., with all the information, you won't get the full rebate. Just bearing in mind that you will get rebates from all your retirement funds. This is just purely for retirement annuity. And the reason for that is because you have a bit more control over the contributions, not a percentage of income. You have a bit more control over which retirement annuity fund that you go with, whether it be with an Gray or a 91. You might have it with a life company such as Discovery or Momentum. You've got the option to choose because it's a personal retirement fund. And then also secondly, a bit more control over the fund selection. Obviously, bearing in mind, it is governed by Regulation 28, and as a class allocation is therefore restricted. So this helps you because you're just increasing your fund year on year over and above the interest that's been earned on your contributions, plus the ad hoc lump sums that you're making every year from your rebates. 5.5 million Rand may not seem like a lot, but really where the benefit comes in is the 14 million that you would apply either to the 1/3 lump sum. So if we took the 94 million this person retires and we times that by 33%, which is 1/3, 31 million is what's the amount that will be taxed currently at this point in time. If you use the tax tables for retirement, you would have 550,000 as a tax-free portion. The balance would then be taxed on a sliding scale. However, because we're taking the 14 million minusing it off the 31, you've got 17 million in addition to the 550. So then you would take that amount and apply it to the retirement tax tables. Alternatively, if you want your money to last longer, then you would take the 14.168 million and you would essentially apply that to your living annuity to not pay tax until that amount is fully used up. And that's dependent on your drawdown and the tax rate at that stage. Just note that the tax tables will be adjusted year on year. There was no changes from the previous tax year, but really in essence, if the bracket range is between 18 and 45, you either will get to your brackets sooner or later, depending on how they change the upper and lower boundaries. I don't think SARS is going to go higher than 45%. If they do, but really have to justify, let's say, going to 48% or 50%, I don't know, it might be possible. But the point is that the principle still stays the same in any calculation, in any program that use the current tax tables. That's just unfortunately what you have to do. So let's go make an assumption now that we're going to go to living annuity and we're going to take the full commutation of 94.7 million and we're going to pull through 94.7 million. It's done for you. Age is pulled through automatically. Escalation is 6%. The growth is 10%. If you were to change over here, let's say you make it 5 and 9, obviously it's going to recalculate the future value, but it also pull through over here 5 and 9. Okay, so I'm going to quickly fix a formula here. Formula is actually meant to pull through over here. And I'm just going to lock it again, just so that we don't accidentally delete formulas. Okay. So now if we make any changes, I'm going to put it back. 6 and 10. Then 6 and 10 will pull through over here. If you guys want this independent, you can make a comment. I'm happy to just unlock the cells and edit them independently. The reason why I just wanted to keep it the same is just so that we have the same assumptions applied to both of these tables, pre-retirement, post-retirement. It just makes it easier. So if we look at 10% growth on the funds and retirement, 6% escalations, 94 million, and we are saying this person's drawing, let's make it 500,000 over here. Okay, so 500,000, you can see it's maxing out 17.5. You're allowed between 2.5 and 17.5. So let's put it on 350. Okay, let's work on 350. So now let's show you how this works. Is we're taking the 94,702,578. If there was an upfront fee, the upfront fee to be deducted off. If you wanted to instead put a, let's say it's 0.75 over here, you can then deduct the 0.75 off the fund every single year, apply your growth of 10%. For now, I'll just leave it off. But we're taking 4.2 million, which is 350 times 12. We're applying the tax on 45%, 45% using the same tax tables over here, greater than 1.8 for the year. So obviously it's 45%. The tax of 45% is 1.89 million. And that's what you would have paid. This is the before and after effect. However, because you've got the total of 14.168 million that did not go towards your tax deduction, you would take this amount and minus 1890 to get to a balance at the end of the year of 12.278 million. You would minus that, until you basically fully deplete the 14.168 million rand, which takes about 6 years before you fully deplete it, which basically means that the tax that you would have paid, just do the calc, obviously just bearing in mind the last one, you're saving 10.6. Okay, well, sorry, in layman's terms, you're saving 14.168 million in tax, and this is how you would apply it. Obviously, if you earn less, let's say you drew 250,000, it'd still take, okay, it's 8 years. Okay, so I would, not that I'm saying that we can recommend it, but the longer you try and defer paying taxes based on the amount you draw. So if you not needing the exact 200,000 at that stage, which is 2.5% drawdown, you can't go any lower than that. If you were to go and put 150,000, it would tell you that you cannot because the minimum drawdown is 2.5. So let's say the person's got other funds with pension or property or other things offshore. Your draw is 2.5%, which equates to 2.4 million rand or 200,000. This person would then defer tax for 9 years because he's applying the 14.1. So that I think would be probably the best case scenario. Obviously depending on the returns, etc. And of course, if the person takes, let's put it back on 500,000, which is a bit higher, you'll see here that this person would obviously use up the 14 million sooner in 4 years, and he would reach the 17.5% drawdown. Okay, in fairness, the client is 82. So depending on their lifestyle and how much debt they have and whether they're still able to travel and things like that, it may not be a bad thing. Because the thing with retirement annuity, living annuities is that your money is going to take a lot longer to run out because when you cap the 17.5, your money actually decreases every year because it's capping. Even though you've got a 6% escalation, it's capping. And as you can see here, this is the income that's supposed to be, okay, this is actually the amount before. So you can see that it actually starts to drop. It goes from 1.2 to 1.1 to 1 million. And as a result, this will last well past 100 when this client has died. And the proceeds of that will go to the nominated beneficiary, which most likely will be spouse if the spouse is still alive. So this graph is just a bit a more accurate depiction of the 14.168. If you change anything here, it will then obviously update everything here. So this is why I just wanted to make this available just for illustration purposes. If you were to go and put in 0.5 and let's say it's 1.3, it'll calculate that as well. And of course, you most likely will reach 17.5 sooner. But the point is, this is something that one would essentially be discussing. You see the tax rate's actually dropped because it's gone below the 1.8, but this client would have been 96 years old. So again, I don't think they would need that income at that stage. Obviously, one needs to look at the buying power of money. In very simple terms, if you took inflation, which will say 6%, and you took 72 and you divided that, you would then have your money halving every 12 years. So it really just depends on what you're looking at. But in essence, this hopefully this will add a bit of value to anyone trying to explain the benefits of their contributions. And then you can decide with investors that do have over contributions what they would like to do. They might do, they might take the 1/3 and apply it there, or the living annuity. Personally, if the client doesn't need the money or has got other investments in place, such as a tax-free savings account, etc., maybe access those funds and then just try and defer paying tax because you don't, you've got the ability to offset. And of course, obviously, the lesser amount you take, say it's 250 here, then the longer it'll take for you to recoup that amount, 8 years in this case. So this person's really looking at just getting an income here of 2.5%. It'll take him 9 years. So he only pays tax in his 10th year, and he'll be 74 years old when that happens before he actually starts paying tax, which is good. because then that money that he would have paid to SARS, which is this over here, which is 14.168, that could, in theory, be kept as an emergency fund. If he's not using the money, because he's going to get the full 2.4 million in the first year of retirement. If he's sort of, let's say, working on 110 net, then that person can then put the money away. Obviously, bearing in mind there are other primary rebates, secondary rebates, depending on your age. But I'm just working on a worst case scenario. If the client has no investments that have those rebates, he's got no retirement funds in retirement, he's only just purely using his primary and secondary rebates that SARS allows based on your age. And then you get taxed on everything else. You might have a medical aid at that stage. And you get, depending if there's still tax credits applicable at that stage, you might get that. But in reality, he's probably going to have very little deductions that he can apply if he doesn't have a retirement annuity or any other fund at that stage. But you anticipated that, and that's why you've got this option here to show how he can deplete his capital over time. So I hope this video creates a bit of clarity in terms of how the second option would work with the living annuity. Watch the first video just to see how I go into the cash flow. I did very briefly show you what happens when untab this. As you can see, there's grouped columns, which also works out the fees. I've just hidden that because it's shown on the second. And over here, there's the calculations for the 27.5. So it first works out what is the actual contribution relative to income. So it's 20%, 28. Obviously, it's higher than 27.5%. It defaults to 350. Or if it's a case where, let's just say it's 600,000, then what it will do is it'll work out 27.5% and it's below 350. So therefore, we're going to take the 240, which is the 165 is 27.5% of that. And because it's lower than 350, we're going to take the 27.5% up until you get to a point where it does the calculation and it gets to 350. So you can see it's capping at 27.5 up until the point where it goes past 350. And then the calculator says, nope, it's higher than that, as you can see. And then once we get to 350 over here, it will start drawing through 350. And that's how SARS would do it. That's exactly how SARS would do it. And when they do their calculations, and then the last one here, it's just working out a few back-end formulas just to get these to work. And lastly, if I haven't shown you, is that you can do a cash flow analysis for 70 years. And on the smaller one, got 34. Actually, should make it 35. I just had to increase the macro range, but I'll leave it for now. And yeah, if you put this onto 120% zoom, it's a bit clearer. And on the living annuity, there's a graph here, which also does the calculations. As you said over here, if we're going to increase this to 500,000, we'll see how the money caps. So yeah, hope this helps. Slight explanation over here. Takes 13 years to reach the 17.5%. This is just a bit of a table which I've taken from a CISA. You can see the 13 years is putting through. And yeah, hope this has value. Thanks for taking the time again to watch this video. I do hope to make some more videos in the future with whichever requests that I get. But hopefully this will encourage investors to save more, reinvest their rebates, and stick to a committed plan to grow as much capital between now and retirement. So this client was obviously younger, so he was 25, but have to do a full table because he gets to 65 later. We'd have 280 million. Of course, obviously you wouldn't start off with 20,000, but you get the idea. Taxable income, let's put it back on 1.2. Okay, well, let's actually work on 600,000. Let's just say that this person was, it's a medical doctor, a very good one. 280 million would be the amount. And I know it sounds crazy, but it's 40 years that you're reinvesting, you're getting your 10%, etc., etc. So that's a lot. Anyway, thanks guys for taking the time. If this video makes sense. If it doesn't, just reach out to me and I'll try and explain it individually. Thanks. Bye.